folks. Thank you for tuning in for another edition from APC on having a plan using diversification. Today we're going to talk about why diversification works for winning the long game. We're not talking about short-term market timing. We're talking about winning the long game. And many clients, when they first come to us, often have only one bucket. It might be they got all their money in the stock bucket. Well, they should really think about maybe having some money on the other side of the ledger. And generally when people do that, they'll park it into the old-fashioned was, I'll say over here, a bond bucket. And when they park their money into bonds, which was a great way to go many years ago, hey, it worked. 35 years ago when interest rates were 8, 10, 12%, that worked. But today, things have radically changed, and we call, when you have all of your money over here, growing broke safely. In fact, I've had some clients come to me and proudly say, Carl, I'm sleeping so good at night. I got all my money in the money market fund. It's been there for 5 years, and I'm not budging. Well, okay. But be aware that when you do that, you're growing broke safely. What do I mean by that? What I mean is, if you're making 1, maybe even 2% interest on your money, and you're taking 3, 4, 5% back because of inflation, you're in a negative return over the long run. So you have to think about how to position yourself to make good money for the long run. And that's what we're talking about here today, diversification. In another series, we'll be talking about higher income and how to get safe higher income. But today, we're just going to talk about being diversified. So the problem when you're over here is you could have a lot of money in bonds, and you might sleep good at night, or it might be in a money market fund, but you're not making the return that you need. Over here, the problem is you might have a lot of volatility, as we've definitely seen in the last couple of weeks. It was a great place to be for the last 10 years, but maybe not so much in the years going forward to have all your eggs in one basket, because as we all know, if all your eggs are over here in the basket, and the basket gets run over, you feel terrible. So we don't want you to feel terrible. We want you to feel good and be able to sleep at night. That's why you may want to think about adding other buckets to your portfolio. Sometimes people will have an international bucket, and they'll park the money over here to get good returns like what worked maybe 10 years ago. This was a real stellar place to be. Sometimes people put money over here in what we call the gold funds. Other times people put money over here into oil. Hey, oil was a going thing 10, 12, 7 years ago, 5 years ago even, but not so much today. And then there's one other area that people sometimes park their money into, the A area, the area that, you know, our friends over at Fisher Investments hate, which is called annuities. And why do they hate annuities? Because, yes, when compared to stocks, in the long run they underperform, but they are a great alternative to these days to putting your money into bonds. Many people are taking money out of bonds and putting it into annuities. Why? Because you can get a safe, tax-deferred return that'll average somewhere right around 3 to 5%, maybe even 6%, depending upon the duration of the annuity that you pick. It's kind of like a long-term CD. We'll get into that more later in another talk, but today we're just going to talk about diversification. So when you are not diversified, or when you are diversified, there comes certain blessings and curses. The blessing of being diversified is, hey, wow, I don't have all my eggs in one basket, and if one of the baskets gets run over, I'm still okay. I've got enough money to make it through retirement. The disadvantage or the curse of having a diversified portfolio is if one sector goes down dramatically, kind of like it is right now, this is your curse, you can say at all times in any given year, you will have one bucket that will dramatically underperform at the expense of letting the other part of the portfolio do dramatically better. It's kind of like a teeter-totter. Here's my little teeter-totter. And when one side of the portfolio is down, the other side of the portfolio does much better. Now, what the art of this comes in is how to balance this out based upon your strategy, your needs for income, and how much you need to sleep good at night. If you are a super big risk taker, well, you can try to be diversified among 2 or 3 of these buckets, but most of our clients usually like to have a variation of all 6 of these buckets to make an investment portfolio work for them. To find out more about diversification and why it really works and how each individual bucket adds value to your portfolio, we suggest that you give us a call, come on in, and let's get a second opinion on your portfolio or update your portfolio to make sure your strategy is working for you. And that strategy isn't just about total return. That strategy is about safe income and sleeping good at night. We want to thank you for tuning in at this portion of called Diversification and why it works to win the long game for investing. Thank you very much.